In this lesson, we're going to talk about the cost of capital. If you look at this chart that we've been looking at almost each lecture or each lesson, you see that we say value of a company is the total present value of all future expected free cash flows discounted by a discount rate. And WACC, the weighted average cost of capital, is the discount rate in this equation. So when we look at this discount rate, the WACC, we see the WACC is a weighted average of cost of debt and cost of equity. And this WACC variable depends on many factors, such as the market interest rate, market risk aversions, the company's business risk, and also the company's debt versus equity mix. So what is WACC? Each company needs to have a game plan for financing the business. The cost of capital is a critical factor in deciding the financing strategy of the company. Cost of the capital depends on the type of financing used. The cost of equity applies to equity financing, and cost of debt applies to debt financing. Many companies use a combination of debt and equity to finance their businesses. And for such companies, the overall cost of capital is a weighted average of all capital sources, widely known as a weighted average cost of capital. So think of the WACC as a weighted average of cost of debt and cost of equity. From the chart in the last slides, WACC is used as a discount rate in the computation of intrinsic value of a company, which is the total present value of all future free cash flows discounted by the WACC. The cost of capital represents a hurdle rate that a company must overcome before it can generate value. Therefore, it is extensively used in the capital budgeting process to determine whether the company should proceed with a project. We will have more discussion about this in the later lesson when we talk about capital budgeting. Capital components are sources of funding that come from investors. Generally, firms have the following three ways of financing. They have long-term debt, preferred stocks, and common equity. Notice that here we focus on the long-term debt because some companies may have temporary short-term debt for seasonal need of cash, but this is usually not part of the capital structure. Current liabilities such as account payable, accruals, and deferred taxes, they are not sources of funding that come from investors, so they are not included in the calculation of the cost of capital. We do adjust for these items when calculating the cash flows of a project, but not when calculating the cost of capital. So if we look at the formula of WACC, you notice that WACC equals to the weight of debt financing multiplied by the cost of debt, and the weight of the preferred stock financing and the cost of preferred stock, and the weight of common equity financing multiplied by the cost of common equity, and then we sum them up. So this is a process of calculating the weighted average instead of a simple average among the three. So we are not adding up the cost of debt, cost of preferred stock, and cost of common equity and then divided by 3 because each company has different capital structure and the weight of each different kind of capital is different. Besides, in this formula, T here stands for the tax rate, corporate tax rate. So take a look at this list of variables. You notice that the total value of capital provided by investors, that's amount of debt, amount of preferred stock, and amount of common equity. So that's the total amount of capital provided by investors. This is provided by debt holders, and this is provided by preferred stockholders, and E is provided by common stockholders. So then if we calculate the weights, WD, that's the weight of debt financing, that's the portion of debt over the total capital. WPS, that's the weight of preferred stock financing, that's the amount of preferred stocks over the total amount of capital. And WS, that's the weight of equity financing, that's the amount of common equity over the total amount of capital. So now let's take a look at the cost of each different kind of capital. We'll start with the cost of debt, RD. We do have different approaches to estimate the cost of debt. We assume that the company has bond or is going to issue new bond. So method 1 is to ask an investment banker what the coupon rate or interest rate would be on the new debt or on the new bond the company is going to issue. Well, if the company does not have bond, in the market or is not going to issue any new bonds, then we can find the bond rating of the company and use the yield on the other bond with a similar rating. So for example, if this company's bond rating is AA, then you can find in the market some other AA bonds and see what is the yield on those bonds, and that could be an estimate for the cost of debt of this company. Answer 3 is to find the yield of this company's bond if the company has any. So then the question you may have now is, why can't we just find out what the interest rate the company is currently paying? For example, we can find from the income statement the total amount of interest expense, and then find the amount of long-term debt they have from balance sheet, and use the interest expense divided by the total amount of long-term debt. Well, the concern here is the interest rate the company has been paying can be called the historical or embedded cost. It can be different from the interest rate for the new debt the company is going to raise, which is called the new or marginal cost. For example, let's just say you bought a house back in 2006, and for your mortgage you borrowed at 6% interest rate. That was the interest rate from 2006, and assume that you did not do any refinancing, then you will be paying a 6% interest rate. But currently, if you get a new mortgage, you will pay maybe just 3 or 3.5% mortgage rate. So historical cost may be different, very different from the new marginal cost. We say the cost of capital is used primarily to make decisions which involve raising and investing new capital. So we should focus on the new or marginal cost. If we want to solve for the cost of debt based on the yield to maturity of the company's bond or a bond that has similar rating, this is something we've done from last lecture. So for example, if we have a 15-year 12% semi-annual bond currently sells for 1153.72, what is the cost of debt? We can use 1153.72 as the present value, and we know this bond pays $60 every 6 months, and there will be 30 payments because 2 payments each year for 15 years, and after 15 years the bond will pay a final lump sum par value payment of $1,000. So then we solve for the IY, we get 5, and this is 5% semi-annual interest rate. Then to find the annual interest rate, we use a nominal rate, so we simply multiply 5% by 2, we get the 10% cost of debt, and we call this 10% as before tax cost of debt. Since interest is tax deductible, we should actually focus on the after-tax cost of debt. When we have 10% before tax cost of debt, we want to multiply by 1 minus 40%. Well, 40% is the tax rate. Then we have 6% after-tax cost of debt. Notice that this tax treatment only affects cost of debt, not cost of preferred stock or cost of common equity, because neither preferred dividends or common dividends are tax deductible. If firms need to issue new bonds to fund the project, there will be issue cost, which usually is a fee paid to the investment bankers. This cost is also called the flotation cost. You can think of it as the cost of keeping the bonds floating in the market. Usually flotation costs for bond issues are pretty small, so many times we can just ignore it. If we don't want to ignore the flotation cost, we can follow the example below to include the flotation cost. If a company is issuing a 30-year bond at par, which is $1,000, flotation cost incurs at 20% of the issue price. Coupon rate is 10% paid annually. When we use a financial calculator, we can try it this way. 30 years annual payment, so N will be 30. And when there is 2% flotation cost, that means for each unit of the bond, the company will receive $9.80. Well, the other $20 will, or say 2% of the par, will be paid to the investment bankers. Then the company promises to pay $100 each every year for the next 30 years. And then by the end of the 30th year, the company promises to pay a final lump sum payment of $1,000. So you notice here we use 980 as a positive number and both payment and future value as negative number. You can also use PV as negative 980, and then payment and future value will both be positive. And then here we solve for the IY. It turns out to be 10.22%. So this is the before tax cost of debt, and if we assume a 40% tax rate, then after tax the cost of debt is 10.22% multiplied by 1 minus 40%. So that should be 6.13% after tax. Now let's talk about the cost of preferred stocks. We use a simple example here. Calculate the cost of preferred stock when the price of the preferred stock is 116.95 and it pays 10% preferred dividends, and the dividends are paid quarterly. And the par value is 100 per unit, and the flotation cost is 5%. So for each unit, 5% of the proceed is paid to the investment banks. The formula we use here, the cost of preferred stock is calculated as the dividend from the preferred stock divided by the price of the preferred stock multiplied by 1 minus F, where F is a flotation cost. So that's why we have 10% of the par, which means $10 each year as preferred dividends, divided by the price multiplied by 1 minus the 5% flotation cost. So in this case, after calculation, the cost of preferred stock is 9%. Note here that flotation costs for preferred stocks are significant, so usually they are reflected in the calculation. We just use the net price after subtracting the flotation cost from the price. That's why in the denominator we have price of the preferred stock multiplied by 1 minus the percentage of flotation cost. And second, preferred dividends are not tax deductible, so there is no tax adjustment. We don't have before or after tax cost of preferred stock, just the cost of preferred stocks. And we use nominal cost of preferred stocks. So you do not have to compound the quarterly rate. You can simply use the annual preferred dividend payment divided by the price adjusted for the flotation cost. And notice that in this example, the cost of preferred stock is 9%, while the cost of debt is 10%. So why is the cost of preferred stock lower than the cost of debt? It is not because preferred stocks have lower risk. In fact, preferred stocks are considered more risky to investors than debt, since companies are not required to pay preferred dividend, while they are actually required to pay their debt. However, of course, firms generally want to pay preferred dividends, otherwise they cannot pay common dividends, and it will be difficult to raise additional funds, and default on the preferred dividend payments may give preferred stockholders the right to gain control of the company, and that may be something that common stockholders want to avoid. Then if we follow the idea that high risk, high return, then why is cost of preferred stock lower than the cost of debt? We need to think about the after-tax cost. Think about it this way. The after-tax yield to investors or the after-tax cost to the issuers are higher on preferred stocks than on debt, which is consistent with the idea that higher risk of the preferred stocks require a higher return for the preferred stockholders,